So vision, execution through a team, and capital allocation. These are the three most important things to look for in any business. One of the biggest risks for India today is that the younger generation is more interested in the capital markets, given how the capital markets have behaved in the last 5-10 years, rather than running businesses. As the business grows, and if the business gets to a point where for scaling it needs a sizable amount of capital, that's when you should think of an IPO.
Hello everyone, welcome to the IMA Podcast 2026 series. I'm here with Mr. Tejas Gutka, who has been appointed the fund manager at Electrum Portfolio Managers in 2025, where he is responsible for the equity strategy, portfolio construction, and long-term value creation for clients in Indian equities. Hello sir, how are you doing?
I'm very well, Ansh. Thank you for having me here.
Thank you so much for the talk that you gave. You talked about Viksit Bharat. You talked about where the Indian markets are going. I want to ask you some specific questions, which I hope that you've not been asked before.
Sure.
When you look at Indian promoters and you're looking to invest in their companies, what are the three things that you would want in an Indian promoter that would encourage you to invest in that person's company?
That's a great question. See, the first and foremost is vision, right? A lot of promoters have built businesses in India in the past, but somewhere the hunger for growth goes away. If you have a family business and it's throwing 10, 50, 100 crores of annual cash flow, the family is very happy, right?
Correct.
Everything's taken care of, and therefore the hunger for growth goes away. So the first and most important thing is how hungry is the promoter to sort of grow from here. Second most important thing is that the promoter should be driving the vision, but he should have a team to drive the vision, because that's how you build multi-generational companies. Right? You don't want to take a single person risk in the business.
Correct.
And the third most important thing obviously is financial prudence, right? When you have a lot of capital, when you start generating a lot of free cash flow, you also get very distracted, right? So is the promoter focused enough? How is the capital allocation history of the company been like? In the past we've seen many companies generated great cash flows and then went and invested in the hottest thing, like bought a hotel chain or something else, right? Which eventually has destroyed sort of wealth for the promoter and for the investors, right? So vision, execution through a team, and capital allocation. These are the three most important things to look for in any business.
Makes sense. So I come from a family business. We're a 75-year-old jewelry retail legacy by the name of Punjab Jewels. We currently have stores in Indore and Bhopal, and we're looking to expand. I just joined the business. I'm the fourth generation in the family business, right?
That's wonderful.
And looking at how the Indian equity markets are growing, looking at how many companies are doing their public offerings, and they're getting capital from the public, I sometimes wonder what is the right questions I should be asking about my business and about where I want to take my company that will help me decide whether my company is ready for an IPO and whether my company needs an IPO in the first place.
Sure. Yeah, I think the second question is more important. But before I get to answering your questions, Ansh, I really want to compliment one thing, that I'm really happy that as a fourth generation in today's time, you've joined your family business. Mr. Uday Kotak in one of the conferences highlighted that one of the biggest risks for India today is that the younger generation is more interested in the capital markets, given how the capital markets have behaved in the last 5-10 years, rather than running businesses. Now, if everyone gets to the capital market, who's going to run our businesses?
Very true.
So it's great that you've kind of decided to join the family business. Now, when will you be IPO ready? You will never know. You will only know it once you do the IPO.
Yeah.
But like I said, the second question is more important. Is you ask yourself, when do you want to IPO? Right? You IPO for two reasons. One is because you want to raise capital at the business level, and the second is because you want to raise capital at the family level. Right? We've built a legacy, we've invested for so many years, and now we want some returns for the family, and therefore we will go and dilute some shareholding and sell our shares. Right? I would suggest that the first reason is more important, right? That as the business grows, and if the business gets to a point where for scaling it needs a sizable amount of capital, that's when you should think of an IPO. A lot of businesses today think of an IPO because I'm getting the valuation.
Right.
Now it also comes with its own set of headaches. A lot of compliance, quarterly calls, meeting investors, answering to investor queries. You have a variety of investors. A lot of investors want you to deliver for the next few quarters. Some investors will come and tell you, no, think of 5 years, sacrifice near-term profit, and so on and so forth. So it's not easy. While it's very glamorous to think of an IPO, a post-listed life is not very easy. And therefore, the real question that you need to answer is, do I need the capital today, right? And then think of an IPO.
Makes sense. So as I grow my business, so we're focused on jewelry retail. That's the only sector that we're currently in. But when I look at other family businesses that are currently leading the Indian business landscape, I see that they're into multiple businesses, they're into multiple categories, multiple sectors, they're conglomerates, right? So I want to get your opinion on this as someone who invests in large businesses and who has seen which businesses grow and which don't. How should I divide my time and how should I divide my focus between trying to grow the segment that has built our business over all these decades, which is jewelry retail, but then at the same time, I also want to expand beyond this one sector because I don't just want it to be a regional family business. I want it to turn into a conglomerate. So, but then I'm always in this dilemma: how much time should I be spending on trying to build and create something that is completely new and different from what we are already doing, and also spending enough time, because you cannot spend enough time on what you're already doing. We always feel like we don't get enough time to do what we're already doing. So what sort of advice, or how would you guide someone like me who's in a position like me? Because I'm pretty sure there are a lot of people who have regional businesses right now, or I'm pretty sure family business heirs who have a business that's doing well for them, but they're at this crossroads where they wanted to grow exponentially, but they also want to grow into other areas, other sectors, other industries, right? So how do I navigate that?
So it's not an easy question to answer, but I think I'll touch upon a few things, right? If you look at the history of corporates across the world, we've gone through waves of corporations becoming diversified and then corporations hiving off everything and becoming concentrated, right? Both has its own risks, both has its own rewards, right? At a certain scale, when the cash flow is big, when the business is built and there is a second layer of management that can manage the business, an entrepreneur does have the bandwidth to think of passion projects, maybe.
Correct.
Right? Now, how do you build these passion projects, right? There are two models that come to my mind, right? First is the Google or the 3M model, where Google and 3M had a policy where 25% of an employee's time in a week, so maybe a Friday in a week, is dedicated to passion projects. You don't have any KRAs on that day.
Okay.
You come to office, you do whatever you like, not in your department, across departments, right? So as a promoter, you say, okay, look, I am going to dip my hands in a few things, but I will minimize the time that I invest there, right? So you go wide, but you don't go deep enough. You go deep only in one business.
Right.
And then if something else becomes meaningful, and then you try and scale that, right? So you experiment a lot, but without investing a lot of time. And if something becomes big, you build it. That's the first model. The second model is how Amazon built multiple businesses. It solved its own problems.
Correct.
And it said, okay, look, where is my biggest cost head today? Right? Can I invest and bring that cost down? And therefore, they went backward and backward and backward, right? That's how today they have multi-line businesses, and each of them throwing a lot of cash flow, and each of them being a multi-billion-dollar business, right? So those are the two ways to build this.
Right.
It's not easy. When you look at Amazon, it's a great success story.
Yes.
But for every one success story, there are 100 stories that didn't work because you got distracted enough. So it's a very fine balance between trying to diversify, whereas remaining focused enough on the one thing that still drives the entire cash flow for the entire family.
Makes sense. So in this world of information overload, where there are hundreds of news channels, there are hundreds of Instagram pages, Twitter pages, and hundreds of influencers that are putting information out there and suggesting invest here, don't invest here, invest in this stock, don't invest in this industry, this sector. How would you recommend a regular investor, someone who is not doing this full time, but someone who just wants to put some of their funds in a good place? How would you suggest them to filter signal from noise, and how do you also do it? Because I'm pretty sure that there are so many research papers and so many opinion papers that would be coming on your desk on a daily basis, and then you have to figure out what should I take seriously, what should I spend my time doing, because if you just keep on gathering the information that you're getting out there, it's never ending. And I think then you go into this analysis paralysis mode where
Sure.
you have too much information, but you're like, okay, but now what do I do now, like with all of this information, right? So how do you decide that, okay, I've learned enough about this company, this industry, this sector, and I think I have enough information to take a call right now? Like, how do you decide between that signal noise and when you decide that, okay, no more information is required now, I think I'm good, I'm confident enough to take a call about this?
So I think multiple parts to your questions. Though I'll answer the first one. See, the investment industry is about 150 years old. The formal investment industry, right? And despite all the technology advancements that have happened over these years, you see, the basic tenets of investing have remained the same, which is that don't get carried away where the herd is, right? Don't all of, if you read any mania or any sort of bubble, it was created because everyone was trying to do the same thing.
Correct.
Right? So the basic tenet is simple: remain diversified. Don't over allocate to one product, which is one asset class or one market cap or so on and so forth. Remain diversified. Remain disciplined, which means continue doing what you do. I think SIP is a great way to remain disciplined because it makes you invest even when the markets are down as well as when the markets are up. So you play the cycles. If you are a little more nuanced investor, then you should understand cycles and say, okay, there is euphoria today. I need to reduce the risk in my portfolio. When you see a scenario like, what's happening with small caps today in India, you say, okay, this is the time to increase the risk in my portfolio. And so you generate that little bit of alpha by simply understanding cycles and playing those cycles well. Right?
Correct.
The typical mindset is when the going is good, I want to invest more.
Right.
And when the markets start falling, I need to withdraw my investments. That's where investors mostly lose out. So these are 100-year-old tenets, and if you just follow these, despite whatever the asset class, whatever the investment product, you will come out as a winner over a 10-15 year. Right?
Makes sense.
Remain disciplined, remain diversified. The two simple mantras, right? That's the first part of your question. Now, second is about information overload. How much is enough, how much is not enough. See, we've gone in, I think about 20-25 years, we've gone from information being an edge, where if you were the first guy to get the annual report 20-30 years back, it was an edge because you could read fatafat about what the company is doing, and not a lot of public information is available, to today where every half an hour you would probably have an update on some company somewhere, right? But even in that era, even in this era, you can never have enough information to make a decision. You have to always make that decision with a 60-70% sort of confidence level. You say, okay, look, I know 60-70% about this, I'm going to start investing, and then you learn more as you go along the journey. So if you're a long-term investor, like how we typically think of businesses in 3-5 year horizons, as we invest and then as we live with that investment, we learn a lot about that. So going from that 60-70% to 80-90% is a journey that happens while you remain invested. Right? You can never be 100% sure.
Yes.
How do you filter out noise? I think we have great tools that are being developed today, right? AI is a great summarization tool.
Right.
At its lowest level, it can summarize so much for you.
Definitely.
Right? And that's how I think we are trying to filter out all the noises, saying, there's so much that is being thrown at us.
True.
Now we use AI as a filtering tool and say, can we try and summarize, can we build models that can understand the way we think and therefore structure a lot of this information in the way we want, and that helps us consume it faster or spend lesser time consuming it and more time thinking about it.
So as AI, as these new tools, new technologies come and disrupt every industry that's around us, as someone who is in the retail sector, I keep wondering, how do I ensure that there is a strong moat around my business? Because even though I'm in the retail space, I'm not in the consulting space or IT space where I think the disruption is happening much more quickly. But I just have this fear of how quickly new trends come into picture. New companies come and they take all the attention, they take all the customers, and they ride this wave of attention, right? So how would you suggest companies to ensure that the trends are going to keep coming? There's going to be new companies always on the go. How do we still make sure that we are focused on our goal, and that we at the same time we have a moat around our business which no new company can just come in and take a piece of, a part of? Because if all the time we're trying to, do that firefighting, we're trying to block all these new companies trying to take a piece of our, market share, then you can't run the business. But at the same time, you cannot ignore them either. So the question just has to do with how a traditional, not a traditional, but how a legacy business, because we try to run our business in a modern sense, but how a legacy business can keep itself relevant while these new companies with the new energies and new people, the new technologies, new tools, they come in and they try to take a piece of the pie.
Sure. So, specifically in your case now, retail again is a model that's existed for over 100 years across the globe, right? And despite all the technological advancements, it's a business that has survived all of these technological, and so there is an inherent moat in the retail model. Second is, even when a large player like Amazon or the entire e-commerce wave came through and everybody thought that the brick and mortar business is going to die, it didn't.
Correct.
These businesses coexist, right? So there is space for everybody to grow. How do you build a moat for any business? The moat is what problem you're solving for your customer.
Very true.
What does a customer want? Right? A retail business is trying to reduce the search cost. Today, the customer doesn't know where to go for what, right? So you put up a shop and you say, I'm going to show you 100 things.
Correct.
And maybe you like one out of that 100, and that's the problem that I'm solving for you. Right?
Correct.
That's any retail business. In a jewelry business, you're solving for a second problem, right? That am I buying what I'm buying? Is how pure is it? Right? So can you build a trust with the customer? Right? So by reducing search cost, by being where the customer is, right? By going to the customer, by opening stores at different locations, you're solving for the first problem. The second problem is something that you solve via integrity, and you say, okay, look, we will ensure that we are always the best quality product and the customer can trust us. 10 years down the line, if he wants to resell his jewelry and he comes to me or any other shop, he's not going to have to take a haircut because the product was a bad quality product. He may take a haircut because the price of gold has moved up and down and so on and so forth, but he doesn't take a haircut for quality, right? So if you remain true to the customer, if you keep solving the customer's problem, and if you don't let your costs bloat, I think those are the biggest moats that any business can create, right? Amazon has a very famous line, your cost is my opportunity, and they've always remained focused on keeping the cost as low as possible, and which is true for any business, right? The moment you start overdoing on profitability or over leveraging profitability, someone else will come and disrupt you. But if you remain very laser focused on cost, it's very difficult for someone else to come and disrupt you. Maybe 100 years down the line you still get disrupted, but you're increasing your runway, if you understand what I mean.
Definitely. So I'm going to ask you one last question, and then we'll end this podcast. So if you were evaluating a family-run business like mine, right, what are the red flags that you would look for? What are the signals that you would look for which would tell you that this is a dying business now, and I don't see this business continuing to grow, continuing to stay relevant? So we talked about what are the opposite of that, like where you would look signs you would look for in a promoter which does where they do well. But for any business, honestly, doesn't just have to be a family run business, but how do you look at a legacy business and you tell, okay, if I see these 3 red flags, I will avoid putting my money into this business and I would not bet on this business to do well in the future?
So I think this is where you think a little top down. Usually we invest very bottom up, which is we look at an individual business and analyze that business. But at some point you also have to think top down. What is the growth rate of the industry? How has the industry grown? What is the penetration of these products, and therefore what is the future growth rate of this industry? If the industry is going to grow at 3%, your business can't grow at 30 forever.
Correct.
Right? There may be some tailwind that you're enjoying today where you would grow, but you can't grow forever if the industry is only growing at 3%. Right? So how much is the industry growing at, and what is the growth runway for the industry, which means where is the product in the maturity cycle at an industry level?
Correct.
And then second is, what are you doing? What kind of moats are you building for you to say that, you could grow faster than the industry or capture a larger pie of the industry? And specifically to your question on family businesses, if you look at family businesses, what has led to ruin in a large part of family businesses is internal feuds. It's been lesser external factors and more internal factors, right? So when you look at a business which is a family-run business and where multiple generations are involved, it's very important for us to assess how how are the responsibilities divided, who's doing what, how is the shareholding divided. Sometimes the fight can just be about shareholding and not about business responsibilities, right? So how does the family mitigate all of these risks at the shareholding level, at a business responsibility level? If the family has multiple businesses, are there cross holdings? Who's running what? Is there clarity within the family? Who's the leader of the family? While everybody is helping execute this business, is there one person who's been appointed as the visionary, saying he's going to drive the strategy, everybody else helps him execute the strategy, right? So those are some of the ways in which we would approach family run businesses.
Makes sense. Thank you so much, sir. Thank you so much for insights. Thank you so much for sharing all that you did. This was Ansh Anand, CEO of Punjab Jewels, with Mr. Tejas Gutka at the IMA podcast. And until next time, keep thriving. Thank you.
Thank you. Pleasure being here.